The top 4 stocks to beat inflation in 2022 and beyond, that is what we're discussing in today's video. Now, we've all been told to worry about inflation as investors, but until you see this insane relationship between stocks and inflation, you might not fully understand why. Over the last 70 years, the annual S&P 500 returns with low inflation were 11.7% on average, while when inflation was greater than 6%, the average returns of the stock market dropped to only 3% per year. Well, recently the CPI inflation data just came out for October and November of 2021, astonishingly high. Just check this out. For October, the CPI inflation came in at 6.2% year over year, being the highest level observed in over 30 years. Then November inflation came in even worse at 6.8% year over year, which was the highest level since 1982, or nearly 40 years ago. Now, as intelligent investors, this just means that we need to be extremely selective when picking our stocks right now, otherwise our money could be eaten up by inflation in 2022. So then you might be thinking, what are the characteristics of an inflation-resistant company? Well, there are 2 that come to mind. The company either must be a natural hedge against inflation, or the company must be able to raise prices along with inflation. In all of the stocks that I discussed today, you'll find either one of these characteristics, making that company inflation-resistant. So anyways, if you do enjoy, guys, make sure to drop a like on the video, as it does really help me out. And if you haven't already, make sure to subscribe so you don't miss any of my future updates in 2022. I also want to thank today's video sponsor, The Daily Upside, which is a free financial newsletter, but more on that later. With that said, let's jump right into these 4 inflation-resistant stocks for 2022. All right, so the first inflation-resistant stock to buy for 2022 is PayPal, with ticker symbol PYPL. Recently, I've made several videos talking about why I'm buying Visa stock, which I'm still incredibly bullish on, but I thought I'd switch it up and talk about PayPal in today's video. So PayPal is one of the world's leading payment processors, facilitating all sorts of transactions over the web. With the growing amount of people working remotely and getting paid online, PayPal is certainly benefiting from this secular trend, and I can say this firsthand, having been paid several times using PayPal. But aside from their main platform, they also own 2 major subsidiaries, which are Venmo and Honey. Venmo has over 76 million users, allowing people to send each other money super easily, like e-transferring, and they just recently announced a partnership with Amazon, allowing customers to now pay using Venmo in the US, which is absolutely huge. Then Honey is the browser extension that allows you to save money when shopping online, basically finding you the best deals and offers all across the web. Overall, PayPal has an incredible business model centered around the global payments space online, which should continue growing for several years to come. One of the best parts about PayPal too is that they're a natural hedge against inflation. This is because they gather a fixed percentage off of every transaction processed on their PayPal network, just like Visa and MasterCard do. But you can also think of it this way: because of the increased money supply across the US ever since the beginning of the pandemic, much of this money will end up flowing through PayPal, which ends up making them a great hedge against inflation. All right, now looking at PayPal stock, we can see that they're down from all-time highs by about 40% just since the end of July this year. And a big reason for the massive sell-off is because eBay is no longer going to be accepting PayPal as a payment option on the e-commerce platform, which has impacted the business worse than expected by management. To give you some background, eBay purchased PayPal back in 2002 for $1.5 billion, then spun off PayPal as its own independent company in 2015. So the 2 companies have had a very solid relationship just up until 2020, when eBay announced that they're not going to be accepting PayPal anymore due to customer inconvenience and the high fees. However, despite the awful news, PayPal is still managing to grow its active accounts above 15% per year in Q3, as well as the transactions per active account growing at 10% per year. In addition, PayPal processed 4.9 billion payment transactions, up 22% year over year, despite eBay marketplace transactions declining 53% year over year. So in total, PayPal was able to grow its revenue at 13% year over year, while still having a 19% 2-year compounded annual growth rate. Now, their earnings growth has stagnated over 2021 because of this whole eBay situation, but I would assume moving forward they will continue to grow their earnings really quickly. Finally, PayPal has a very strong balance sheet with cash and cash equivalents of $20 billion in Q3 and total debt of $8.9 billion, which they could completely pay off if they really wanted to. Overall, I'm bullish on PayPal, and if they can resume earlier growth rates within their earnings and their revenue, which I'm sure they will be able to as soon as this whole eBay thing passes over, I'm sure the stock price will follow. All right, now before we get into stock number 2, I want to tell you about today's video sponsor, The Daily Upside. The Daily Upside is a free financial newsletter that shares some of the most important and engaging stories in business delivered to you before the market open every weekday. As an avid stock market investor, I like to make sure I'm caught up on the most most important financial news relating to the markets and the companies that I follow, which can be very time consuming. However, the Daily Upside makes this process simple through reading their 5-minute newsletter, which is quite entertaining to read, unlike other traditional financial news outlets. For example, I just read that the Fed Jerome Powell plans to discuss speeding up its reduction of asset purchases, which could end months earlier than the initial target of mid-2022. That would give the Fed the scope to raise interest rates earlier if inflation doesn't cool down, which could certainly affect my stock portfolio. Therefore, I've decided to pivot and focus on buying more inflation-resistant companies for the most part to try and outperform the market in 2022. So make sure to click the link in the description or the pinned comment below so you can sign up for the Daily Upside newsletter completely for free. Anyways, thanks again to the Daily Upside for being today's sponsor, and let's get back to the video. All right, now the second inflation-resistant stock that we have on the list today is a real estate investment trust known as Allied Properties with ticker symbol AP.UN.TO. Allied Properties is a Canadian REIT with a strong portfolio of office and retail properties in the downtown core of all major cities. And for those who aren't aware, real estate has always been known to be a great natural hedge against inflation. This is because homes and properties are always in demand, so more money to the people just means more money flowing into real estate at the end of the day. Not only do real estate prices rise though, but rents rise accordingly, meaning that REITs with shorter term contracts or inflation adjusted contracts will benefit over the short term from rising inflation. So here we can see for Allied Properties that the weighted average lease term to maturity is 5.6 years, while if we compare this to Realty Income, theirs is 8.8 years, meaning that Allied Properties will be able to increase rents more quickly with inflation. Now, looking at their portfolio, Allied Properties has a diverse mix of tenants within their top 10, such as Google Canada, the bank Morgan Stanley, Bell Canada, Shopify, and TELUS, which are all incredibly stable and reliable tenants. Furthermore, as of the end of September 2021, the REIT has a tenancy occupancy rate of greater than 90%, which is great to see. We can also see here that Allied Properties has seen tremendous growth in both its assets and its share price over history since going public back in 2003. Their assets have grown at a rate of 26% per year on average, while shareholders have seen returns of 14% per year on average, including distributions. Allied Properties is also very focused on growing the company's net asset value or NAV per unit, as well as the distribution per unit over time, which is exactly what you need to be looking for before buying a REIT. And speaking of distributions, Allied Properties has an excellent track record of increasing them each year since 2012, and they never even cut it during the Great Recession either, they just held it constant. They also just announced a distribution increase for 2022 from $1.70 per unit to $1.75 per unit annually, which is a small 2.9% increase from 2021, but it is still an increase nevertheless. And of course, this is a monthly dividend stock, so you are going to be receiving these distributions every single month of the year, making it a great investment for passive income. Finally, taking a look at their balance sheet, we can see that the company has an interest coverage ratio of 3.4x, which means that they're not going to miss an interest payment on their debt, even if interest rates rise over the future. We can also see that they have $8.7 billion of unencumbered properties, which is 93.6% of their portfolio. And this allows them to take out more debt if they really need to in the future, and basically they have tons of room to grow. Overall, I can only see real estate continuing to grow year after year into the future. It's something that's not going to slow down anytime soon, especially given the inflation, and I think that Allied Properties is in a great position having that 90% lease rate with their tenants, as well as having all of these great locations across Canada in the major cities. Now, the third stock to benefit from rising inflation is Canadian National Railway with ticker symbol CNR.TO in Canada, or CNI on the New York Stock Exchange. CNR is of course Canada's largest railroad that spans from coast to coast, but also offers transportation to and from parts of the US. Now, unlike PayPal and Allied Properties, I would not consider CNR to be a natural hedge against inflation. However, what they do have is incredible pricing power, which allows them to increase their revenue alongside inflation by passing on higher costs to the customer. And if you think about it, railroads essentially act as monopolies within their respective regions of operation. For example, if CNR is the only railroad that can offer transportation to and from a pulp mill, for instance, that company is reliant on CNR, so the mill will have to absorb any increases in transportation costs if CNR decides to raise prices. And since CNR is one of North America's premier railroads, they can quite easily increase prices, as seen from this slide in their investor presentation. So outside of train fuel, CN's prices have exceeded rail inflation by nearly 2% in 2021, which is solid performance to say the least. But now let's get into their Q3 earnings report recently released on October 19th to see how they're doing otherwise. So CNR reported revenues of $3.6 billion in the quarter, representing growth of 5% year over year. Then they reported EPS of $1.52, representing growth of 10% year over year. Finally, they've been able to produce over $2 billion of free cash flow year to date, which they are predicting is going to exceed $3 billion. And this is the amount they can use to perform share repurchases or pay out dividends. And speaking of dividends, CNR has a solid dividend track record, having paid and increased their dividends for decades at a very rapid rate, nearly 10% per year over the past 5 years in fact. And although their dividend yield is quite low right now at only 1.5%, the payout ratio is also very low at only 36% right now, meaning they have tons of room to grow it over the near term. Overall, owning one of North America's best railroads during times of inflation will certainly do you very well, but I would only purchase CNR on a dip. I wouldn't really buy right now because the stock fluctuates up and down, and right now it is at those all-time highs, so I probably would wait for a dip as it is pretty expensive. Finally, the fourth and last stock to benefit from rising inflation is one of the Canadian banks, and that would be TD with ticker symbol TD.TO, or in the US, it's TD. TD is Canada's second largest bank with a market cap around $175 billion, while they also have a very large presence in the US, which has propelled their growth over recent years compared to many of the other Canadian banks. Now, I won't get into too many of the details about TD. I don't want to bore you because I recently made a video about the Canadian bank stocks, link above. But what you do need to know is that TD will be a great natural hedge against inflation over the coming years, and here's why. With rising inflation, the Fed will be forced to raise interest rates to keep the economy from overheating, which is inevitable at this point. And unlike many other types of companies, banks actually become more profitable with rising interest rates, not less. Their net interest income rises as their net interest margin expands when interest rates rise, thus making them more profitable for each loan that they sell. Anyways, TD is a great pick not only because they're going to be a great hedge against inflation, but because they actually just announced incredible earnings, so let's get into it. In their Q4 earnings, TD reported adjusted net income of $3.9 billion, up 30% year over year, and adjusted diluted EPS of $2.09, which was up 31% year over year, while revenues were up 5% year over year. In addition, TD just announced a quarterly dividend of 89 cents per share, up from 79 cents per share in the same quarter last year, representing annual dividend growth of 13%. And as we can see from their dividend history, this increase is above their average annual dividend growth rate of 11%, showing that the company is stronger than ever and they're doing very well. And based on the current share price of $95, the dividend yield is at a solid 3.75%, with a payout ratio of only 43% based on the most recent quarterly earnings. But aside from dividends, TD also just announced a huge increase to their share repurchase program. In Q4, TD announced that they plan on repurchasing up to 50 million common shares, which at the current share price represents about $4.75 billion of shares on the open market. And in total, this is about 2.75% of the outstanding shares. So I absolutely love the fact that TD is rewarding shareholders through both dividends and share repurchases, and that the company is doing incredibly well right now and should continue growing very quickly during times of inflation. Additionally, the company has proven total shareholder returns of 12.4% over a 5-year compounded annual growth rate, which is great to see and reinforces my opinion on TD being a great investment. Overall, my top 4 stock picks to beat inflation in 2022 and beyond are PayPal, Allied Properties, Canadian National Railway, and TD Bank. But if you do have any other stocks that you think would be great hedges against inflation, like Visa that I've already talked about, let me know down in the comments below. I would love to hear them. But anyways, thanks for watching. If you did enjoy, make sure to drop a like on the video, subscribe down below so you don't miss any future uploads, and then if you haven't already, make sure to check out my community of investors, the Discord community, which I will be linking to below. And with that said, I will see you guys in the next one.